60 million ounces vanished from London vaults in 18 months. Not stolen, not lost, simply claimed. I've spent weeks analyzing the data, and what I found keeps me awake at night. This isn't a market correction. This is the moment when paper promises collide with physical reality, and reality is winning. Right now, as you're reading this, something unprecedented is happening in the global silver market. For every 1 ounce of physical silver that exists in deliverable form, there are approximately 50 paper contracts claiming ownership of that same ounce. Think about that for a moment. 50 promises, 1 reality. What this really means is that the silver market has become the largest shell game in financial history, and the shells are getting lifted, one by one. I discovered this pattern while tracking COMEX inventory data. In October 2024, registered silver stood at 80 million ounces. By December 2025, that number had collapsed to 43 million ounces. But here's what caught my attention. This wasn't gradual. The largest drains happened in single-day withdrawals. November 17th alone saw 6.13 million ounces pulled from vaults. That's not normal profit-taking. That's someone who knows something. But this is where the story gets dangerous. Those 43 million ounces in COMEX vaults represent less than 3 weeks of global silver consumption. Yet the paper market continues to trade as if infinite supply exists. Every futures contract, every ETF share, every derivative instrument assumes that physical silver will be available when demanded. But what happens when 50 people show up to claim the same ounce? The answer is written in the mechanics of what I call the Great Silver Heist. This isn't a conspiracy. This is the logical endpoint of a system built on an impossible foundation. The idea that you can create infinite paper claims on a finite physical resource without consequences. Here's what nobody's talking about. While retail investors chase paper silver through ETFs and futures, institutions are quietly demanding physical delivery. JP Morgan alone has accumulated an estimated 675 million ounces since 2011. That's more than the Hunt brothers ever controlled, more than entire nations hold in reserves, and they're not alone. I've traced similar accumulation patterns across multiple major institutions. They learned the lesson from 1980. Don't fight the paper market. Become the paper market. Control the rules. Then, when the time is right, demand what's actually yours. The mathematics are brutal and simple. Global silver production peaked at 880 million ounces in 2015 and has been flat to declining since. Industrial demand has exploded to 689 million ounces annually. Investment demand adds another 200 plus million ounces. But here's the kicker. Recycling only provides 180 million ounces. The deficit isn't theoretical, it's structural, persistent, and growing. Now, layer on top of this the paper market expansion. The largest silver ETF, SLV, claims to hold 440 million ounces. But read their prospectus carefully. In case of shortage, they can settle in cash. Your silver might just become a check. When everyone realizes simultaneously that their silver doesn't actually exist, what do you think happens to the price? The pattern I'm seeing isn't unique to silver. Every major commodity crisis in history follows the same sequence. First, paper markets obscure reality. Second, fundamentals deteriorate quietly. Third, someone tests the system. Fourth, the illusion collapses violently. We're deep in stage 3. China just implemented export restrictions on January 1st, 2026. 4 major South Korean banks suspended silver sales indefinitely. India's imports hit records as citizens convert paper wealth to physical metal. And here in the United States, Google searches for how to buy silver just hit all-time highs. This is what a bank run looks like in slow motion. I need to show you something that happened in 1980 that explains everything we're witnessing today. 2 Texas oil billionaires, Nelson and William Hunt, did something that terrified Wall Street so completely that they changed the rules of the entire financial system. They exposed the paper silver market for what it really was, a house of cards built on promises that couldn't be kept. The Hunt brothers accumulated 200 million ounces of silver between 1979 and 1980. But here's what most people don't understand about their strategy. They didn't just buy silver, they systematically demanded physical delivery of their futures contracts. Every contract they held became a claim on actual metal, not a paper settlement. And the vaults started emptying. January 1979, silver traded at $6 per ounce. By January 1980, $49.45. That's 724% in 12 months. But this wasn't speculation. This was mathematics. The Hunt brothers had discovered the same truth. I'm showing you now. There wasn't enough physical silver to cover all the paper promises. Here's where the story reveals its pattern. As silver climbed toward $50, COMEX panicked. On January 7th, 1980, they implemented Silver Rule 7. Translation: you can sell, but you cannot buy new long positions. They changed the rules mid-game. The Hunt brothers were frozen out of their own strategy, but silver kept climbing anyway until margin requirements were raised so drastically that holding futures became financially impossible. March 27th, 1980. Silver Thursday. Silver collapsed from $21 to $10.80 in a single day. The Hunt brothers lost $1.7 billion. They declared bankruptcy. Brokerage houses teetered on collapse. Banks froze credit markets for 48 hours. The entire financial system nearly broke. But here's the lesson everyone forgets. The people holding physical silver didn't lose anything. When the dust settled and the paper market finished its meltdown, silver was still trading at 1080, 80% higher than where it started. The Hunt brothers failed because they used leverage and played by rules that could be changed against them. Physical holders walked away winners. This pattern isn't unique to the Hunt brothers. It's the blueprint for every commodity crisis in history. Let me show you two more examples that prove this mechanism. Nixon's gold window, August 15th, 1971. Foreign central banks had been converting dollars to gold as the Bretton Woods system required. But America had printed far more dollars than it had gold to back them. When France and Germany started demanding physical delivery of their gold, Nixon slammed the gold window shut. The paper gold system collapsed overnight. Gold went from $35 to $850. Physical holders won. Paper dollar holders learned an expensive lesson about the difference between promises and reality. Palladium, 2000-2001. Russia controlled 60% of global supply and mysteriously delayed shipments, just as auto manufacturers needed palladium for catalytic converters. Physical supply vanished. Futures contracts became worthless because there was no metal to deliver. Price spiked from $500 to over $1,000. Paper traders holding futures got crushed when delivery failures cascaded. People holding physical palladium became very wealthy very quickly. 3 different markets, 3 different decades. Same pattern every time. Paper promises work until someone tests them. Physical reality always wins. Now let me show you why 2026 is different and more dangerous than any of these historical examples. First, the scale is exponentially larger. In 1980, the silver paper market was perhaps 10 to 1 leveraged. Today, we're looking at ratios of 50 to 1 or even 100 to 1 in some derivatives markets. The Hunt brothers controlled 200 million ounces. Current open interest in silver futures represents claims on over 1.2 billion ounces. But total global above-ground stockpiles are estimated at only 2 to 3 billion ounces, and most of that is already in industrial applications or jewelry. Second, industrial demand didn't exist in 1980. Silver was primarily monetary. Today, solar panels, electric vehicles, 5G infrastructure, medical devices, and AI data centers consume over 60% of annual supply. This isn't speculative demand that can disappear. This is structural, persistent, and growing demand that creates a price floor under physical silver. Third, the geopolitical dimension is completely different. In 1980, America controlled the rules. Today, China just implemented export restrictions on refined silver. India is importing record amounts. Multiple governments are treating silver as a strategic resource. When nations compete for finite resources, individual investors typically get priced out first. But here's where it gets really interesting. The institutions that matter learned the Hunt brothers lesson. They're not making the same mistakes. Instead of using leverage to corner the market, they're quietly accumulating physical metal while maintaining the paper market illusion. JP Morgan didn't just learn from 1980, they perfected the strategy. Since 2011, JP Morgan has reportedly accumulated an estimated 675 million ounces of physical silver, while simultaneously being one of the largest short sellers in the paper market. Think about that strategy. Suppress paper prices through short selling, accumulate physical metal at artificially low prices, then wait for the inevitable supply crisis to expose the paper market's vulnerabilities. This isn't market manipulation in the traditional sense. This is chess played on a level most investors can't even see. And right now, we're watching the endgame unfold. Here's what I discovered when I dug into the mechanics of modern silver markets that made my blood run cold. The system isn't just leveraged 50 to 1 or 100 to 1. In some derivative markets, the leverage reaches levels that would make casino operators blush. But the real mechanism is far more sophisticated than anything the Hunt brothers faced. I call it the perpetual promise machine. Here's how it works. Step 1. Create paper silver instruments that look and feel like ownership, but aren't. ETFs like SLV hold physical silver supposedly, but buried in their prospectus is a clause that allows cash settlement if physical metal isn't available. Your silver investment becomes a currency bet. Step 2. Layer derivatives on top of those ETFs, options on silver ETFs, futures on silver indices, swaps based on silver volatility. Each layer creates more claims on the same underlying physical metal. It's like issuing multiple deeds to the same house and hoping nobody shows up at the same time. Step 3. Use the paper market to suppress physical prices. When too many people start buying physical silver, flood the futures market with short positions during low volume trading hours. Create the appearance of selling pressure. drive prices down just enough to discourage physical buying. This mechanism worked perfectly for over a decade, until it didn't. The first crack appeared in November 2025, when lease rates for physical silver spiked above 5% annualized. That means people were so desperate for actual metal that they'd pay 5% interest just to borrow it for short periods. Lease rates had been near zero for years. This wasn't a market fluctuation. This was the sound of the physical market breaking away from paper control. Then came the Shanghai premium explosion. Physical silver in Shanghai started trading $3-4 above London spot prices. That's unprecedented. When physical metal trades at sustained premiums to paper prices, it means the paper market is losing credibility as a price discovery mechanism. But here's where the hidden mechanism reveals its true nature. As physical premiums rose and lease rates spiked, what did the paper market do? It ignored the signals completely. Futures continued trading as if infinite supply existed. ETF flows continued as if every share represented actual metal. The perpetual promise machine kept running even as its foundation crumbled. I've been tracking something else that nobody's talking about, the velocity of physical silver movement. In normal markets, physical metal moves slowly. Industrial users order months in advance. Investment demand is steady and predictable. But since August 2025, I've noticed an acceleration in physical flows that suggests panic buying beneath the surface. Large bars are being melted down into smaller, more liquid forms. Refineries are reporting unprecedented demand for conversion services. Private vaults are expanding capacity faster than they have since 2008. These aren't the actions of a stable market making routine adjustments. These are the actions of informed players positioning for systemic breakdown. The most telling indicator appeared just last week. For the first time in over 2 decades, several major precious metals dealers reported allocation systems for silver purchases. They're not sold out, they're rationing. When dealers who have managed supply chains through multiple market cycles start rationing a commodity, it means they see something in their supply chains that terrifies them. Meanwhile, the banking sector is sending mixed signals that reveal the depth of this crisis. While retail banks like those in South Korea have suspended silver sales indefinitely, investment banks continue to promote silver ETFs and derivatives to retail customers. It's as if they're encouraging people to buy paper claims on metal that may not exist while refusing to sell the physical metal itself. The mathematical reality is becoming impossible to ignore. Global silver production peaked at 880 million ounces in 2015 and has been declining since. Industrial consumption has grown to 689 million ounces annually. Investment demand adds another 200 plus million ounces. That's 889 plus million ounces of annual demand against 813 million ounces of mine production, plus about 180 million ounces from recycling. Even basic arithmetic shows a structural deficit of nearly 100 million ounces annually. But here's the hidden mechanism's most insidious feature. It's designed to fail gradually, then suddenly. Each year of deficit drains above-ground stocks. Each layer of paper claims increases systemic leverage. Each month that passes without a crisis makes the eventual crisis larger and more destructive. We're watching this failure cascade in real time. China's January the 1st export restrictions weren't just policy changes. They were recognition that silver has become too strategically important to allow unrestricted export. When producing nations start hoarding their own production, consuming nations get cut off first. The perpetual promise machine is about to meet a hard wall of physical reality. And walls don't negotiate. Stage 4 isn't coming. It's here. The eruption begins with something routine. A major industrial user announces they cannot source enough physical silver to meet production schedules. The announcement triggers immediate panic buying, as companies realize the same supply constraints could hit them. Within hours, the cascade accelerates. Futures contracts fail delivery. COMEX restricts physical settlement. The paper market fractures from reality permanently. Physical silver doesn't just rise, it gaps. $74 today, $120 tomorrow, $180 the day after. Industrial buyers bid against each other for remaining metal while paper contracts become worthless digital information. Retail investors holding silver ETFs discover their shares are being cash settled against their will. The silver they owned becomes a check based on the last official price before trading halts. Physical dealers stop posting prices entirely. This is when the great silver heist completes its final phase. People who accumulated physical metal watch from safety as the paper market destroys itself. Institutions that learned from the Hunt brothers' mistakes reap generational returns on metal acquired at artificially suppressed prices. But this breakdown doesn't happen in isolation. Silver is the canary in the coal mine for the entire precious metals complex. When silver's paper market collapses, it exposes the same vulnerabilities in gold, platinum, and palladium markets. The dollar, already weakened by decades of money printing, faces a crisis of confidence, as people realize paper claims on real assets aren't worth the paper they are printed on. Central banks discover they can't print silver. They can't algorithm their way out of a supply deficit. Physics doesn't care about monetary policy. What we're witnessing isn't just a silver shortage. It's the end of the era when paper promises could substitute for physical reality indefinitely. The Great Silver Heist is about to be exposed for what it always was, the largest financial magic trick in history. The choice you face isn't whether this happens. The mathematical certainties guarantee it. The only question is whether you understand the implications before the rest of the world wakes up. Physical silver is still available. The window exists, but it's closing with each vault withdrawal, each failed delivery, each paper contract that can't be settled in actual metal. The pattern is completing. The Great Silver Heist is about to end the only way it could, with physical reality crushing paper promises once and for all. Do you see the pattern clearly enough to position yourself on the right side of this historic wealth transfer? Share your thoughts in the comments.